Well, hello and happy Sunday, everybody. How good is this fall weather? Whether you're in Atlanta, GA, or where my business partner and our chief investment officer with Exit Wealth, Matt Goldstein, is located in beautiful Boulder, Colorado. You almost can't lose, Matt, in our 50 states in October, man?
It is definitely a great time of the year. Got
Well,
snow on the mountains here, so it's already getting
do
there.
you? Up on the 14ers and like the 12?
Yep.
Really? Good.
Yep. We got our first dusting, so we have now snow-capped tops.
And the Broncos won, so everybody in Denver is in a good mood. All right,
Yep.
so listen, hey, the Falcons did too. Hey, so great to see everybody, and gosh, we have a treat today. If you're just joining us on Farmers Market, boy, you've picked a first good episode to check out because not only is the 60/40 portfolio dead in our view, and the 40 has in old days been bonds, but we're going to talk today specifically about why and what we believe you should be in instead. So bonds have got a problem. They have a fundamental problem, especially in our great country. And are we still the number one economy in the world? Absolutely. Is our firm still huge believers in US exceptionalism? Absolutely, we are. And we invest thusly. However, when it comes to bonds, they are roadkill to us. So there are a few exceptions. For some people, munis make sense. I knew you'd like that, Matt. But without further ado, I have teed it up. I am holding the football for you and put it through the uprights, Matt. Why do you dislike bonds in most instances?
Yes. So at the end of the day, when you make an investment, you would like to make money. I think that's pretty understood. Um, and bonds, Justin, when we were in elementary school, 1980, the 10-year treasury had a 16% yield. And for 40 years, it went straight down all the way till the COVID bottom at 50 basis points. So as you bought bonds, you got a nice yield, and then your principal also went up. But at its most basic level, what people don't really understand is that when you buy a bond, let's just use the US 10-year treasury because that's kind of the benchmark. If you buy $100,000 of a US treasury right now, you're saying, okay, here, Mr. Government, I'm going to give you $100,000. You'll say, thanks, Matt. We're going to give you 4 grand a year for 10 years, and then we're going to guarantee your $100,000 back in 10 years. You can't lose. Well, remember, all that really is a guarantee of paper currency in the future. And the one thing that I don't think anyone really has any confidence in is what is $100,000 going to be worth in 10 years? And if you just think about it from a most basic economic 101, supply and demand, no matter what side of the party you on, it doesn't matter. We all know they have to keep borrowing more money. So how does the government borrow money? Well, most likely the Fed prints money and then they buy the bonds from the US government. And so we're at $36 trillion in debt. In 2000, we were at 4 trillion. 4 trillion to 36 trillion over since 2000, 25 years is 7.5%. Our debt's been growing at 7.5%. However, the average yield you've gotten over that period is about 3 or 4.
Right.
So may not, basically you are not protecting yourself against the almost inevitability of the debasement of currency, which means not inflation, just the fact that that paper dollar bill is not going to be worth as much in the future.
So in real terms, think about a 10-year, right? You're thinking, great, I loan the government $100,000. And this feels good to me because I get a little return and they give me $100,000 back in 10 years. However, the fatal flaw is
Well, and then this whole thing of the government going bankrupt, that's a joke
that's
because
not,
all they have to do is hit a button and create money out of thin air.
and
Now,
that
if you
and
loan,
that's it. And sorry, Matt, but that's the thing, right?
right,
The fact that they can print money, which they have shown that they will do, um, it's simple math. It devalues the dollar.
right, and they have to. This isn't political. This isn't even economic. It's just basic facts.
Right.
With the amount of debt that we have at 37 trillion, a $2 trillion deficit, they have, and then we're not even factoring in Social Security obligations, pension obligations, Medicare. Like they're going to have to print more money, which means the dollars you receive back in the future, in my opinion, are pretty much guaranteed to be worth dramatically less. And if you zoom out, the market tells you what's going on. Why do you think gold is up 60% year to date? Because you
Gold.
can't print gold. You
Right.
can't print it out of thin air. Now, if I borrowed money from the US government and they said, hey, you got to pay me back in 100 ounces of gold, that'd be a different conversation. But guess what? They can't do that. And by the way, in 1971, that's when Nixon got off the gold standard because all dollars were backed by gold. And you know what happened? Just a little history. France basically said, you know what? We got all these dollars. We'd like our gold. And then that's when Nixon was like, you know what? We're going
We're
to
good.
change that.
So gold, speaking of having its best year since 1979, and sorry to pat ourselves on the back, but we've been buying gold and silver since
Yep.
January and February. But I digress. So Matt, let's cut to the chase. People are watching, saying, "Okay, fine. If you guys don't love bonds, I trust you. We're not going to buy bonds. Share with the folks what we're buying for our members and why."
Yeah, so great question because bonds in general, especially from 1980 to 2020, never went down. You never lost money because as interest rates down, price went up. So there's this 40-year belief of like, well, bonds are safe, you can't lose money. By the way, TLT, which is the ETF for the long 20-year long treasury bond, cumulatively is down 57% over 5 years. So if you bought a basket of US long term treasuries 5 years ago, you have lost 37% of your money, including the yield.
Yeah.
So, but obviously, look, not everyone wants to be 100% invested in stocks because no matter, even though we can have a great strategy, there's going to be drawdown. So, on the safe money front, you can get the same amount of yield on a T-bill as you can basically a longer term treasury for the most part. And then also what we look at is, hey, how can we get return safely without a lot of volatility? And that's where we go into alternatives. We use assets that generate cash flow in the 8 to 12% range, which we feel is going to at least keep us up to speed with the compound annual growth return of 7.5% on the debt. So that's one way we can do it. And then also hard assets. Hard assets, silver, gold, Bitcoin, roots with real estate. You can't print a home out of thin air. So these are ways that we can still be, um, you know, moderate risk without, because right now, just real quick, bonds used to be the risk-free rate of return. Well, in 2020, when the 10-year hit 50 basis points, it was return-free risk. You made 50 basis points a year and had nothing but risk. And so that's what's kind of starting to get a little bit more mainstream right now.
What's interesting, in the middle of the week last week, some of the big sort of shotgun approach alts like KKR and some similar actually got hit pretty hard. They're getting flushed with cash and they're doing smaller returns. So kind of dovetailing briefly, Matt, into what we talked about a couple of weekends ago, which is not all alternatives are the same. I think about alternative investments the way I think about the state of Florida. It's very diverse. There's a big, someone says you want to go to Florida. My first question is what part?
Yeah.
There's a big difference between Kissimmee and Key West. I've had fun in both, but at 50 years old, I'm going to Key West.
Yeah.
So the point here is, everybody's talking about alternative investments and their alts and they sound sexy and all that because they know that their bosses are wanting them to push them. But what I'm saying to you, if you're just watching this and you are running your own investments, A, be careful because you're not a professional. And B, if you are, and some people can do it if you devote a lot of time to it, you better really know what you're doing when you're vetting alternative investments. We,
Yeah. And I just want to add one thing. Like,
yeah,
it's not that I think you're going like obviously in 2020 with interest rates at zero, you could lose a lot of money, which I just expressed. You did lose a lot of money. It's not that I think you're going to lose a bunch of money buying bonds right now. It's the fact that your capital has a very high chance of not keeping up, not with inflation, but the actual printing of money in the future and the debasement. And so that's why we don't really feel it's a proper allocation of capital, except for like, look, if you need money in 2 to 3 years, no problem. Have it in T-bills, getting 4%, right? T-bill and chill, because you know you're going to need that. But long term, you're most likely going to lose to the money printing and the growth of the debt. There's unlimited supply of US debt, and that's not going to change.
Which for another episode is why we like Bitcoin. It's just why, and Ethereum for that matter, and Solana. But that's no longer too far out there. But again, that's an
Yep.
episode for another Sunday. Matt Goldstein, Chief Investment Officer of Exit Wealth in Boulder. How many miles did you run this morning? How many miles did you run this morning?
Uh, 10, but I'm on the down. So the 100 mile race in Phoenix is less than a month away. So I'm on the taper. So now we get to like slowly run less and be at full strength. So we'll do a maybe I'll do an update. Maybe I'll do a little farmers market update from from Phoenix right before the race or after the race.
So you only did 10 miles this morning. What a wuss. All right, Matt Goldstein, love you, buddy. Hey,
All
everybody,
right.
enjoy your
Thanks.
Sunday. Take care. See you soon.